It's our September update, actually being recorded on September 7th, which is the
We got a
day
little,
after Labor Day. Right, Mikey?
yep, we got a little behind with our, we had some technical issues with the first recording.
Technical issues, nothing like technical issues. And we're basically giving a market update, not a lot. Market still, September tends to be the worst month of the year, but, going in from August was one of the best ever. And September so far doesn't seem to be, starting off not that bad.
Yeah, absolutely. I spoke with Chris just prior to us recording this, talking about what are some of the changes that he's seen in the market in the past month since our last video. And some of the points he brought up is that just, some rotation as far as economic growth goes from the value stocks now going more towards the growth stocks. The bond prices have continued to rise, and it's been across the spectrum, the munis, the corps, the high yields. And that commodity prices had started to come down, but supply constriction was still affecting a lot of products. One of the concerns over the past month has been the effect of the Delta variant in some emerging markets, such as Vietnam, which produces a lot of the parts that get used for other things. And the Delta variant in those areas has kind of furthered the constriction of product availability.
You're bringing up a good point about commodities that I want to just address. And that is that, Hurricane Ida came through, devastating hurricane and so forth. And the media pounded on it. This is horrible in the sense of gasoline's going to go through the roof because third of our oil production and gasoline has been, and they're just pounding on this. Oh, we're going to pay $5 a gallon for gasoline now. And yet the price of gasoline went down. And this is a good lesson. Do not listen to the media and what they have to say, because they're normally wrong. And I don't mean that insulting to them. I just mean it in the sense that if you think you know what the market's going to do on a day-to-day basis because of whatever, you're normally wrong. And the media proved that beyond a shadow of a doubt with Hurricane Ida.
Yeah, it's on that same topic. Yahoo Finance is a website that a lot of people use frequently during the day to check prices on various things. It's the one that I use the most. And I think it's comical how quickly they changed their headline from doom to greed and back to doom again and to greed based on the last 15, 20 minutes of trading.
If you're listening to media and what they're telling you, you're making a mistake because they don't know. And I don't mean it
specifically to the markets.
Yeah, for markets. You take information from them and you go and you research it and you watch what the markets are actually doing, not what media is telling you. Because like you said, the market's going up and media starts talking greed. 10 minutes later, the market starts going down, and next thing you know, the headline's talking fear.
Yep. Well, and that plays right into our financial planning topic for today, which is, you had spoken in the past couple of weeks about the correlation of volatility and growth and the importance of understanding that relationship.
Well, that's an interesting concept you're bringing up. I'm glad you brought it up. Not like it was planned or anything, but anyway. Everybody wants to make a good rate of return, but there is an absolute correlation to the volatility of your portfolio and the rate of return you're going to get. Now, does that mean if your portfolio is going like this, that you're going to get a fantastic rate of return compared to one that's doing this? And the answer is no, that's not exactly what I'm saying. But a portfolio that's doing this can make 100 or 200% rate of return. Whereas a portfolio that's doing this can probably make a 10 to 20, 25% rate of return. Or it could go down 10, 20, 25%. A portfolio that's doing this is normally only going to make a 1 or 2% rate of return, if that. Because that's what volatility does. It's the risk that you can lose money that causes the opportunity to make money, because there's an absolute correlation between risk and rate of return.
Right.
That's why all investments compete off of the risk-free rate of return. What's the risk-free rate of return? The treasury bill. Right now it's yielding 0.03%. So if I said to every listener out there, the treasury bill, 30-day treasury bill is paying 10%, I bet you a lot of our clients would say, Drew, just put me in a 10, a
Yeah.
30-day treasury bill, right? Wouldn't you,
Sounds
Mike?
good.
I would do that,
Yeah.
you know? But if I say it's paying 0.03%, they're probably going to say, you got to give me a better rate of return. And I'm going to say, well, because the risk-free rate of return is so low, we're going to have to accept volatility in order to make a higher rate of return. There's a correlation between it that we must understand, and you have to stomach the volatility of your portfolio. And we are not, there's only been one company that I've ever seen who seems to have some ability to eliminate some of the downside volatility and still get tremendous upside potential. And that's Renaissance Technologies. Jim Simons, he was a PhD in mathematics. He's a math wizard. And he and his team in the late, trying for 40 years, Mike, 60s and 70s and 80s and 90s. And finally, in the late 90s, they seem to have come up with a model that nobody knows, totally proprietary to them. They don't manage anyone's money but their own, but they seem to have the ability to make 25, 30, 40% rates of return with only nominal downside volatility. It's never been recorded, even with Warren Buffett. Warren Buffett never recorded that kind of minimization of volatility.
So the reason that we're trying to bring up this concept of volatility and the importance of understanding it is it's times like these when the markets have been very favorable to us that it's important for us to make sure that we understand the volatility of how we're invested or the potential volatility of it, and that we are committed to it. The reason being is, as Drew said, there's almost no one out there who can perfectly time a market, know when to get in, know when to get out, with absolute certainty. And as a result of that, when we look at with clients at how to construct their portfolio and how to decide how much risk they should take, we're largely looking at forecasting cash flows and making sure that we have the right amount of cash or the right amount of bonds and fixed and other, more secure, less volatile securities to get us through periods of volatility so that we don't sell on the equity side of the portfolio when we're in a period of volatility. So that's the point of this, is to ensure that you understand kind of how you're invested, understand how much, risk your portfolio has. And when is the time to best let us help you understand that? It's during the financial reviews that we send out. Krista sends out lots of emails for, and we send some calls out to schedule those. That's one of the really important topics to cover is, do I understand how much volatility is in my portfolio and am I committed to it?
Yeah, absolutely. And it's knowing that we can get through those periods where the markets are down by using cash and bonds that we've set aside to lessen the volatility and get us through those down periods, allow the equity portfolio to recover, and so forth. So unless you think the end of the world is coming, there's not a logical reason to sell during those downturns, because history is proven through the Civil War, the stock market survived and went higher. Through the Great Depression, the stock market survived and went higher. Through World War II, the market survived and went higher. Through the inflation of the 70s, the market survived and went higher. Through the 2001, September 11th, 2001, the market survived and went higher. And through the pandemic of 2021 and the real estate bubble of 2008. The market survived and went higher. And yeah, there were times where it was down. You didn't lose money unless you were the one that sold in the downturn. If you did, then you lost money. But if you held, you survived and you made it through it. And our job is to make sure that we have enough cash and bonds to make it through those periods of time. Do those plan reviews. Make sure you're talking with your advisor and letting us know what your cash needs are for the next 5 years. And we should be able to make it through those downturns.
Yep.
And we do everything possible, Mike, to keep the portfolio diversified so that we're not betting on any one specific category. Like a lot of people we see now are betting on the S&P 500, thinking the S&P 500 does nothing but go up forever and ever, amen. But there have been long 10, 15-year periods where the S&P didn't go up, like in 2000 to 2010. The S&P made a negative rate of return for that 10 years. International stocks did extremely well during that 10-year period of time. And so remaining diversified, different types of asset allocations get you through those periods of time and so forth. Do we have anything else that we need to talk about?
I think that's it.
That's it? Well then, this is Drew Tignanelli saying God bless.